Good morning, everyone. This is Marshall Gidler bringing you the morning comment for March 30th. The dollar was opening higher in Europe, even as U.S. rates ended the day lower Friday. Fed Chair Janet Yellen Friday said a rate hike was likely this year, but that rates would rise only gradually. Now, judging from the market response, the statements increased the market's conviction that a rate hike is coming, therefore the stronger dollar, while lowering the market's assumed path of rate increases, hence lower interest rates. The Commitment of Traders report showed that while investors generally became less bullish on the dollar, reducing their long DXY positions and closing out some short currency positions, they increased their net short euro position substantially to a record short position. This suggests that in addition to dollar strength, we're likely to see euro underperformance in the coming week. That's probably because Greece is the focus of attention again. Prime Minister Tsipras will update Parliament on talks held over the weekend between the Greek government and the group of creditors formerly known as the Troika. Greece apparently has submitted the long-awaited list of reforms to the lenders, but according to the FT, the list depends too much on optimistic economic assumptions and still has too little detail. Now, just how much longer does Greece have? Some reports have said that it'll run out of money by April 8th. If so, and they still haven't worked out their differences by now, then we could be in for some last-minute tensions. Oil plunged on Friday as diplomats worked towards a settlement of the Iranian nuclear issue. Settling that problem would free about 1 million barrels a day of supply to come onto the world market. Now, I remain bearish on oil because of the increase in U.S. supply, as I may have mentioned on Friday, regardless of what happens with Iran. This would suggest long dollar CAD and long dollar NOK positions could be profitable. Japan industrial production fell in February, more than expected. Some of the decline could be due to the Chinese New Year in February. Nonetheless, the news highlights how fragile Japan's recovery is and likely reaffirms the administration's commitment to a weaker currency to encourage exports. It's yen negative. Today's highlights, during the European Day, the German CPI for March is coming out after several regional states released their data in the course of the morning. As usual, we'll look at the larger regions for guidance on where the headline figure may come out as an indication for the near-term bias of the common currency. A better than expected headline figure could, better meaning higher than expected headline figure could support the euro a bit. In the U.S., we get personal income and personal spending for February. Now, personal income is expected to rise at the same pace as previously, while personal spending is anticipated to rise, a turnaround from the previous month. The year-on-year rate of growth of core PCE, the Fed's favorite inflation guide, is forecast to remain unchanged. Pending home sales for February and Dallas Fed Manufacturing Index for March are also coming out. For the rest of the week, the highlights will be the Bank of Japan's Tankan Business Survey for Q1 on Wednesday and the U.S. non-farm payrolls on Friday. We could see the yen weaken on the former and the dollar strengthen on the latter. More details as the dates come near. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.